57% now, Sandy Golf November.
Welcome back, everyone. Today we're going to look at some of the beaten down stock. As you know, the market is not giving any premium to some of the growth stocks. So on top of the list is your HIMS and HERS with a market cap of roughly around 7 to 8 billion. It's fluctuating almost 10-5% on a daily basis. They have a revenue growth of 69% year over year in 2024 and 49% year over year for Q3 2025. They have an earning coming in very soon, so we'd love to see what that number is for Q4. My verdict is that it's a strong 10x candidate. When I'm talking about 10x, we are talking in the range of 3 to 5 years of range. And when I'm saying 10x, 7 billion to 8 billion could be roughly 70 to 80 billion. And you just look at their recent chart that came down from $70 to $16-17. That's roughly at the peak it was already valued at roughly 30 to 40 billion dollar. So I'm not saying something fancy it cannot be achieved. It's already 5x achieved last year itself. So now let's look at what are their key pillar for their analysis. Market opportunity, they are having a very great TAM with 100 plus billion in telehealth and DTC healthcare. The regular shift to personalized at home care, massive GLP weight loss market opportunity. So that's huge. Just think about it like the way they have expanded from for providing fertility related things or pregnancy related stuff or a hair loss. These are very niche area, but they have expanded it to those niche area from there to weight loss. Now they're doing cancer testing kits. So that's, I think they set up a platform that helps them to execute these different product lines very rapidly, and not just in US, they may enter into international as well. So as I said, like industry momentum, telehealth and DTC healthcare is a red hot. AI-driven personalization, they are already doing it, directly challenging the traditional pharmacy and insurance model. And again, like one of the another thing is that the Trump RX, I think somewhere Trump RX maybe actually help HIMS and HER. That will have a pressure on the traditional pharmacy, but it will eventually help people to move to online. Smart money, strong institutional ownership, Cathy Wood or ARK is buying. Management has still have the meaningful stake in it. Revenue quality, revenue is growing 50 to 70% consistently. Gross margin is 75%. Subscriber growth is the most important metric. Would love to see that from 20 plus percent year over year in Q4 as well. Path to profitability is already profitable, and net revenue retention is also very important. They literally expanded it from I think $20 to a month of $80 a month. That's 19% year over year. So just think about it. A user who is spending on Netflix is $15 or $10 or $20. There on HIMS they spend $80, and with a gross margin of 75%. So just think about it from Netflix point of view. You will feel like, hey, this is a very cheap stock to buy. Strategic interest from pharmacy chain insurers, that's a buyout catalyst. I don't see that as happening, and they have a legal case from Novo Nordisk. So I think these are there. When you run a business, you always have your headwinds as well coming in, but these are temporary. This will now or later will be solved. So it's just a matter of fact, like how long this can, the legal risk can, impact the stocks, but eventually they will get out of it. Founder-led management has executed flawlessly on vision, clear target that they have a target of 7 billion revenue and with an EBITDA of 1.3 billion. If 6.5 billion revenue that they target, usually they exceed it. 7 billion, I'm talking about 10x revenue multiple for 20% or 30% growing business. You can easily have $70 billion market cap. And product velocity is something which is very required for something if you are looking for 10x opportunity. Launching a new specialty rapidly, platform approach, not a single product, and then a strong customer retention. And as I said, like they are expanding internationally as well. So UK, Canada, EU all on the table. Red flags, the major red flag is the regulatory risk around the compounded drug. But I think this will go away. They even may not have the weight loss related things. They may go into, the cancer testing, the other type of services as well, maybe on the dialysis side or something which has at home care. So once you set up your platform properly, you have all the other line of business executing properly. Adding a product line is, I think it's just a matter of time. When they have the regulatory concerns covered, they will be able to launch it. So yeah, HIMS is building Amazon of healthcare, personalized, tech-enabled D2C. The platform is hitting inflection with the weight loss, but the real story is expansion into a prevention care, diagnostic, and chronic disease management. As I said, like the prevention care, diagnostic, and chronic disease management is something which they can do. And just think about the blood test and all that. Those are most likely you will be in a position that you will do blood test at home. You just pack it, drop it in the package, and then you will have your results. So they're not just gonna hit like they're also gonna hit your LabCorp and QuestLab and so on. So HIMS is my favorite 10x stock. Second is ZETA. It is the kind of the market cap it has and the growth it has. To be honest, I've not been able to understand their business model properly. How they have been able to grow 38% or 30% plus almost on a regular basis. Since I don't have the marketing side experience, so I don't touch their products, so it feels really odd to put it in the list. But it's still based on the metric I'm seeing. ZETA is doing really well. 5 billion market cap, growing at a 30+% year over year. That definitely make them a strong candidate for 10x. Marketing Cloud, MarTech TAM is your 200 billion plus AI native platform, benefit from AI replacement cycle. Targets $2 billion revenue by 2028. So something which is generating 2 billion revenue. If they are EBITDA positive on this and growing at a 30% even, this could be almost 15 to 20 billion dollar easily market cap. I think their main concern is that since we have the software eclipse, the AI-driven marketing is exploding, but at the same time you have a lot of new companies coming in, or the existing company coming in with the AI solutions on top of it as well. Institutional ownership decent but not overwhelming. Founder-led company. They recently launched $2 million. Not recently, like a year back, they launched $200 million share buyback authorization, and I think they have already exhausted it. So roughly, they have bought it around $20 or $18 in the range of that. And if you are buying below that, it is currently I think trading around 15. So they may do another buyback. That was the management was saying in the earning calls. But let's see if that's really a thing. Revenue growing 20 to 50% straight 6 years, straight 17 beat and raise. There's something which set up a credential for their forecast, and company is not just there to put up the number without any actual analysis and so on. Buyout, I think this is pretty feasible. They are at very cheap price. Ideally, some of the big platforms should be able to buy them at some premium, and then I think ZETA will have a good exit as well. Although David Steinberg is already someone who has like a pretty strong background in the VC side. He already laid out a plan in 2024, I think, about a ZETA 200 billion plus revenue plan. And this guy is pretty smart. So let's see how the leadership is able to track on the $2 billion plus revenue. Product velocity, Athena AI agent launch, OpenAI integration, customer RPU growing 19 to 33% year over year. Super scaled customer counts growing 25% year over. Red flag, small market cap, liquidity risk, recent stock price decline, low trust on the company, competitive market landscape. There are big players in the MarTech space. There was a short report on this. The way they collect the data is not right, or legally challenging thing, whatever they are doing. Not sure how the short report was. Eventually, like that short report led to a drop of $30 from $30. I think ZETA was reporting in the end of 2024. They dropped it to $20 and then recovered a little bit and then dropped further again. So yeah, I think ZETA is. I see them 3 to 5x going by in 3 to 5 years. 10x will be overfetched, but M&A is very possible. So yeah, let's look at IoT. Samsara. Apparently, nobody's talking about IoT. They have a market cap of $14.5 billion. They are growing at a revenue of 33% year over year and 29% year over year Q3 2025. Very high potential in growing. I think 3 to 5x. 10x will be overfetched because they are in the logistic TAM, and the TAM of the logistic side is not that huge. Although they say like the IoT TAM is 556 billion. This realistically, that's a IoT TAM, not on the logistic side. So 40% of the global GDP is physical operation and massive runway. So that's there. They are the pioneer in, I think, logistic IoT side. IoT adoption is accelerating. AI integration is the key differentiator. Regulatory tailwind, safety and compliance mattered. So these are the momentum for them. Strong money, strong institutional ownership, founder led, some insider selling, but not massive. Revenue quality, they have annual recurring revenue of $1.64 billion, growing 30%. Customer retention is strong, 100K plus ARR customer growing 31%. Gross margin is healthy, operating margin is still negative, -5 to 8%. Part to profitability is very clear. Buyout catalyst, I don't think so that's a buyout candidate, but still there are potential that IBM, Cisco, Microsoft, these kind of companies can get into this space. Founder-led, clear execution, a strong customer satisfaction. These kind of like hit your leadership really well. Product velocity, AI feature rolling out, predictive maintenance, analytics, platform network effect, processing 4.2 petabytes of data daily. These all are great. What I don't like about the management is that their stocks dropped from I think $50 to 25, and yet the insiders are selling. The management is not coming out and telling anything about like what's wrong with their business or good with their business. You can take it in two ways. This whole silence from the management. They are there for long-term run. They are there to work on their product and let the product do the talking, rather than coming out and publishing, article or tweets and things that can pump their stocks and make it stable. So I see them on the on the more quieter side, who loves to do on the actual product rather than talking about it. 10x opportunity, that would be a stretch. Red flag is not yet gap profitable. Valuation 79x forward PE. It is, but the way they have their ARR and the net retention rate, I think it's around 110% net retention rate or 120%. Obviously, stock is down 30% year to date. That's pretty bad. So there still is the category leader in the connected operation, but at a market where it needs to become a 145 billion for a 10x candidate, that's a stretch. More realistic would be 3 to 5x. If they can achieve profitability at a scale and maintain 20 to 30% growth, the IoT TAM is massive, but execution risk and valuation are concerned. Better as a high conviction 3 to 5x than a pure 10x play. Okay, that's 3 candidate for me. HIMS 10x candidate, ZETA 2 to 3x candidate, and IoT 3 to 5x candidate in 3 to 5 years. So let me know what you think about these 3 stocks. Are there any other stocks that you would want me to look into it? Happy to deep dive into any of these stocks which you recommend. So feel free to comment, like, subscribe. Thank you, everyone. See you in the next one.